Hi students, how are you? Can you hear me? Okay, so I welcome you all in class. We will start from IS 10. Events after reporting period. And this is IAS 10. Now, what is the definition of events after reporting period? We have a financial year. For example, the financial year is started from 1st January X1 and it is going to end. Yes, it is in the notes. It is in the notes. And financial year end is 31st December X1. 31st December X1 is the year end. It is a cutoff date. And the financial statements of this year end, for example, will be authorized for issue, let's assume on 28 Feb 20X2. Now the events which will took place between the year end and the financial statement authorized for issue, those events are known as events after reporting date. Events after reporting date. So we can define the events of reporting date. If we define these events as events between year end and financial statements are authorized for issue. Those events are known as events after reporting dates. Those events can be favorable, can be unfavorable, but those events will be known as events after reporting date. And those events are dealt in IS 10. For example, after the year end, but before the authorization of financial statement, uh, for example, a customer file a case against you, against the company, that will be known as events of reporting date. After the year end, but before the finalization of the financial statement, you sold the inventory and you find that the sale price, the NRV is less than cost, that will be events after reporting date. You come to know that one of your customer has now bankrupt, that will be known as events after reporting date. So the events which took place between the year end and the financial statement are authorized for issue, favorable or unfavorable, those events are known as events after reporting period or reporting date. Now, these events which are events after reporting date can be described between two events, two types of events. Adjusting events and non-adjusting events. When we say the adjusting event means such events which will be adjusted in the financial statements. Adjusting event means those events which will be adjusted, about which the double entry will be done in a financial year end of 31st December X1. And non-adjusting event means are those events which will be disclosed only in financial statements. We will give only disclosures about the non-adjusting event. Non-adjusting events are not adjusted in our financial statements. Now, which event will be adjusting and which event will be non-adjusting? Adjusting events are those events conditions or condition of which arise before or at the year ended. Those events whose condition arise before or at the year end, those events will be known as adjusting event. Now, for example, you come to know that a customer who was existed at the year end has become bankrupt, and this information you come to know after the year end, that will be known as adjusting event. For example, you have sold the inventory after the year end, which confirmed that at the year end, the NRV was less than the cost. That will be known as adjusting event because the condition of that event was existed at the year end. For example, there was already a litigation against you and that was finalized after the year end, but before the authorization of the financial statement, that will be an adjusting event because the condition was existed at the year end. So for every event whose condition was existed at the year end, that will be known as adjusting event, and it will be adjusted in a financial statement. We will do the double entry. And non-adjusting events are those events whose condition arose after the year end. Those events whose condition arose after the year end, those events are known as non-adjusting event, and those events will only disclose, we will only give a disclosures of those events in the financial statements. For example, you come after the year end, there is a fire in a factory, there is a natural disaster after the year end, there is an earthquake after the year end, a change in tax rate after the year end, change in foreign exchange rate after the year end, restructuring plan was announced after the year end. All these events are non-adjusting event because the condition of event is arising after the year end, and that for the non-adjusting event we will give only disclosure in the financial statement. They will not be disclosed in the financial statements. You get the definition? Okay, please read the following just example. Read this example. Please read the following example. You read the example? Any confusion? And non-adjusting events are those events whose condition exists after the year end, and they will only disclosed if they are material. And the example of the non-adjusting events are a fall in a value of an asset. For example, a large fall in a market value of some investment owned by the entity between the year end and reporting period and the date of financial statement authorized for issue. A fall in a market value after the end of the reporting period will normally reflect the condition that arise after the reporting period has ended. No condition already exists before then. The acquisition or disposal of a major subsidiary after the reporting period will be a non-existing event. An announcement of restructuring or discontinuation of the operation, announcement of the commencing or implementation of the major restructuring, destruction of a plant or an asset by a fire after the reporting period or due to a natural disaster of the reporting period, change in tax rate, change in foreign exchange rate after the reporting period. All these events are an example of non-adjusting events, and they are only disclosed in our financial statements. For dividend, we have if the dividend is proposed before the year end and declared after the year end, the declaration is the event. And if the declaration is taking place after the year end, the dividend will be a non-adjusting event. Dividend will be a non-adjusting event. It will only disclosed in the financial statements. Going concern, if due to any event, whether that is adjusting or non-adjusting, if the going concern of the business is affected and business is no more going concern, then we will prepare the financial statement. The financial statement will be prepared again. And if the going concern is not anymore, then the financial statement will be prepared on breakup basis. Breakup basis mean the asset will be recorded at realizable values and liabilities will be recorded at settlement values. If the going concern assumption is affected and business is no more going due to any event, whether that is adjusting or non-adjusting, we will re-prepare the financial statement on breakup basis. Okay, so that was the IS 10, and this is chapter number 10. This is chapter number 10 from your notes. You can study IS 10 from chapter number 10, and this is the accounting standard which was also part of financial reporting FR, and we need a little bit knowledge of IS 10 at SBR level as well, and that is enough. The knowledge given in the chapter would be enough for SBR level. Now we will move to the next topic, and the next topic is non-current asset held for sale and discontinued operations. and that is IFRS 5. So what is held for sale and what are discontinued operation is covered in IFRS 5, and it is very important accounting standard. If we talk about the definition, for held for sale, held for sale is an asset or a disposal group. Disposal group means that could be a branch or a company or a subsidiary company, or a disposal group whose recoverable amount will be covered through only fair value less cost to sell. Held for sale is an asset or it is a disposal group whose recoverable amount will be covered through only fair value less cost to sell. That means the value in use for held for sale, value in use of held for sale asset is normally zero. They are not held for use, now they are held for only disposal. It could be an asset or it could be a number of assets, or number of assets means it could be a disposal group, but the recoverable amount will be covered through only fair value less cost to sell. Fair value less cost to sell mean only through sale transaction. That asset or group of asset, that asset or group of asset is known as held for sale asset. For example, let's assume we have a plant, we were using that plant and we used that plant for last 6 years, but now company decided that they will dispose the plant, they will sell the plant and they will change the old plant with a new one. Then that means the old plant in the financial statement will be known as asset held for sale. You get the definition? The students, you get the definition? Now, what will be the recognition criteria? What will be the recognition criteria? Or you can say what will be the conditions to classify an asset as an held for sale? Following is the recognition criteria. Number one, asset must be available for immediate sale in the current condition. Asset must be available for immediate sale in the current condition. Number two, sale is highly probable. Sale should be highly probable, and highly probable means authorized by management. That means sale has been authorized by the management who has the authority to sell the asset. Active plan to find the buyer has been started. And number three, asset is actively marketed at reasonable fair value. Sale will be completed within 12 months of classification. And last one, it is unlikely that plan will be withdrawn. Now, if all these conditions are fulfilled, asset is available for immediate sale and sale is highly probable, and for highly probable the sale is authorized by the management, active program to find the buyer has been started, asset is actively marketed at a reasonable fair value, sale will be completed within the 12 months of the classification, and it is unlikely that the plan will be withdrawn. If all these conditions are fulfilled, then a non-current asset will be treated as or will be recognized as an asset held for sale, a non-current asset held for sale. This is the criteria. You get it? Don't you get this? Now, if the asset is classified as held for sale, remember the following points. No depreciation, no depreciation will be charged. The assets which are classified as held for sale, on those assets, no depreciation will be charged. Number two, asset held for sale will be presented below the current asset in statement of financial position. Asset held for sale will be presented below the current assets in statement of financial position. That's mean in a statement of financial position, there will be non-current assets, then there will be current assets, and after the current asset, there will be assets held for sale. So there will be three headings on an asset side in a statement of financial position. Number three, they will be measured at the below of or at the lower of carrying value or fair value less cost to sell. Okay. So these are the points you people need to remember for the assets which are classified as held for sale. Recognition criteria and the accounting. No depreciation. They will be presented below the current assets in a statement of financial position, and they will be measured at the lower of carrying value or fair value less cost to sell. The other thing which is discussed in IIFRS 5 is known as discontinued operations. Now, first of all, what does the meaning of discontinued operation? Dear student, discontinued operations are components of entity which are being disposed or classified as held for sale and represents the separate geographical area or production line of the business or part of single coordinate plan to dispose a separate geographical area or production line of the business or it's a subsidiary company acquired with the view of resale. If that component of the entity which has been disposed of or classified as held for sale represent any of these three, a separate product line or geographical area of the business or a part of the single coordinated plan in which the management has decided to dispose of a separate geographical area or a production line of the business, or it is a subsidiary which has been acquired with the view of resale. If that component of the entity represent which has been disposed of or classified as held for sale represent any of the following of these three, then that means we are talking about a discontinued operation. Then the disposal of that component or the classification of that component will be treated as a discontinued operations. And if that is a discontinued operation, just remember one point, that the profits of discontinued operations disclosed on the face of financial statements separately from the continuing operations. The profits of discontinued operations will be disclosed on the face of the financial statement separately from the continued operations. That means the profitability of the continued operation will be presented separately and the profitability of the discontinued operation will be presented separately if that component of the entity which has been disposed of or classified as held for sale represent any of the following. And we have chapter number 4. Of the notes in which you can find the IIFRS 5 asset held for sale and discontinued operation. This is the accounting standard which were we are discussing. Okay, please read this example. Read the first example. That entity R had the following asset on 31st March year 4. A property that is offered for sale for 5 million during the year June year 3. The market for this type of property was deteriorated, and at 31st March year 4, the buyer had not yet been found. Management does not wish to reduce the price because it hopes that the market will improve. Shortly after the year end, the entity received an offer of 4 million and property was eventually sold for 3.5 million during May year 4, shortly before the financial statement were authorized for issue. So what do you think, whether this property can be classified in year 3 as held for sale? If you read the answer, you will find that the market, the price which is company is asking, management is asking, is too high as compared to fair value, because it was sold for 3.5 million. And in a year 3, company was asking for the 5 million. So the asset was not marketed at a reasonable fair value. So if the asset is not marketed at a reasonable fair value, that means it is not possible that asset could be sold. If we are not selling something at fair value, if we are demanding too much as compared to the fair value, obviously the customer is not going to buy that and at that asset. So this property cannot be classified as held for sale in a year 3. You get it? Then a plant with a carrying value of 2.5 million at 31st March year 4, the entity had ceased to use the plant, but was still maintaining it in a working condition so that it could still be used if needed. It still could be used if needed. Entity R sold the plant on 14th May year 4. Yes, what do you think about the plant? So the year end is 31st March year 4. This is the year end. And the one point that they're still maintaining it in a working condition. If they're still maintaining it, that means the asset is not available for immediate sale. So I think it should not be classified as held for sale in the year ended 31st March year 4. Now read the answer. At the year end, management had not made the firm commitment to sell the plant, even though the plant was sold just after the year end. IIFRS 5 prohibit the classification of non-current asset as held for sale if the criteria are met after the end of the reporting period and before the financial statements are signed. Therefore, the plant cannot be classified as held for sale. Okay, so the conditions are fulfilled after the year end. At the year end, the conditions were not fulfilled. So that's why the plant cannot be classified as held for sale on the year ended 31st March year 4. Okay, you get it? Okay, read this case study. Read this case study. Read the case study. Okay, have you read it? First requirement is discuss the accounting treatment which firm should adopt to address each of the issue above for the consolidated financial statements. Okay, the accounting treatment need to be discussed. So first of all, background, the firm is a manufacturer of the white goods such as washing machines, dishwashers. The industry is highly competitive with a large number of products on the market. Brand loyalty is consequently an important feature in the industry. Firm operates a profit-related bonus scheme for its managers. This is an important information to note. Based upon the consolidated financial statement, but the recent results have been poor and bonus targets have rarely been achieved. As a consequence, the company is looking to restructure and sell the 80% owned subsidiary New Wall, which has been making substantial losses. The current year end is 30th June 2008. Farham has a production facility which started to show a sign of subsidence since January exit. It is probable that the firm will have to undertake the major repairs sometime during X9 to correct the problem. Repair. Farham does have an insurance policy, but it is unlikely to cover the subsidence. The chief operating officer refuses to disclose the issue at 30th June X8 since no repair have yet been undertaken. Although she is aware that this is contrary to the international accounting standard. Chief Operating Officer does not think that the subsidence is an indicator of impairment. She argued that no provision for the repair to a factory should be made because there is no legal or constructive obligation to repair the factory. Farham has a revaluation policy for the property, plant and equipment, and there is a balance on the revaluation surplus of 10 million in a financial statement for the year ended 30 June 2008. Revaluation surplus of 10 million. None of this balance relate to the production facility, but the chief operating officer is of the opinion that this surplus can be used for any future losses arising from the subsidence of the production facility. Okay, now my question from you, that whether the opinion of chief operating officer about the repairs, that no provision for repair should be recognized as there is no legal or constructive obligation. Is it correct or not? What do you say? What's your opinion? Anyone else? The chief operating officer is of the opinion that no provision for repairs and maintenance, should be made. Repair and maintenance is a future operating cost. Repairs and maintenance is a future operating cost, and as per IAS 37, no provision for future operating cost will be made. Have we studied this in IAS 37? No provision for future operating cost should be made. So if IAS 37 is saying that no provision for future operating cost should be made and repair is a future operating cost, that means the chief operating officer opinion is right. Chief operating officer is on with the right opinion that no provision should be made for repairs. Okay, you get it? Okay. My next question is whether the subsidence is an impairment indicator. Subsidence mean the building is falling. Building is falling. Whether it is an impairment indication or not. Yes, it is an impairment indication. It is an impairment indication. If it is an impairment indication, we know a impairment test should be conducted. An impairment test should be done. We will study IIFRS 36. So I'm leaving this point, but it is an impairment indication. An impairment test should be done. Now, whether the impairment test will be done for the building only or for the entire cash generating unit, it depends that whether the factory building represent the cash generating unit or not. But we will discuss this thing later on in IIFRS 36. The third point in this part, in this case study, is that the chief operating officer is of the opinion the revaluation surplus which is relating to some other assets can be used for any losses which we will book against this factory building. Is it correct or not? Can we use the revaluation surplus which is relating to some other class of the asset for a different class of the asset? Can we do this? It is a basic question of IAS 16. Answer is no. We cannot do that. It cannot be done. If we have a revaluation surplus relating to some other building, some other factory, it cannot be used against any losses of this factory building. Okay? It is a very straightforward point. You get it? Please read it. Give a quick read. Now, sale of new wall. Now, at 30th June X8, Farham had a plan to sell 80% subsidiary new wall on 30th June X8. This plan had been approved by the board and reported in the media. It is expected that Old Castle, an entity which is currently own other 20% of the new wall, will acquire 80% of the equity interest. The sale is expected to be completed by December X8. New wall is expected to have a substantial trading losses in a period up to the sale. substantial trading losses. The accountant of the firm wishes to include the expected cost of disposal and future trading losses The accountant of the firm wishes to show the new wall as held for sale in a consolidated financial statement and to create a restructuring provision to include the expected cost of disposal and future trading losses. Okay, tell me, can we make a provision of expected disposal loss and future trading losses? Can we make a provision? What do you say? Can we make a provision for a future trading losses? Yeah. No, we cannot make. Well done. So here the accountant is not right. Accountant opinion is not correct because I-37 strictly prohibit to create a provision for future trading losses or expected cost of disposal. Thus, the chief operating officer does not wish new wall to be disclosed as held for sale nor provide for expected losses. The chief operating officer is concerned as how this may affect the sale price and would almost certainly mean the bonus target would not be met. The chief operating officer has argued that they have a duty to secure the high sale price to maximize the return of the shareholder of firm. And she has also implied that the accountant may lose his job if he were to put such provision in a financial statement. The expected cost from the sale are as follow. Future trading losses 30, legal cost 2 million, redundancy cost 5 million, and impairment loss 8 million. Included within the future trading losses is an early payment penalty of 6 million for lease asset, which is deemed surplus to the requirement. Okay, now in this question, as you told me that the future trading provision for the future trading losses and the expected cost of disposal, provision related to these costs cannot be made, and here the accountant is wrong. Such provision should not be made. And at this point, the chief operating officer is also right that no provision should be made for the future trading losses. But as far as the point is concerned, that the chief operating officer does not wish to show the new wall as held for sale, it is not correct. It is not correct because for an asset or a group of asset or disposal group or a component of the entity to classify as held for sale, it should be available for immediate sale, and sale is highly probable. And one of the criteria of the sale should be highly probable is that the sale should be completed within 12 months and we have located the buyer. So in this case, we have the old castle, we have located the buyer who will buy the company, and this company will be sold by December X8 within the 12 months. So the criteria to classify the new wall as held for sale has been met. So it should be disclosed, it should be presented as held for sale. So at this point, the chief operating officer is not correct. You get it? And the third point, restructuring provision. Provision of restructuring will be made. Provision for restructuring will be made because the plan has been approved and it has been reported in the media. So we have a formal plan and plan has been communicated to the affected parties. So the condition has been met. So provision for restructuring should be made, but the provision which will be made will be consist of 2 million legal cost, 5 million redundancy cost, and 6 million early penalty to cancel the lease agreement. So 2576, so the provision of 13 million will be made.
So we will made a provision of 13 million in the financial statement of Farham for the year ended 30th June 2008 as for the sale of the new wall company. You get it? Okay, now please read the answer. Read the answer. Okay, have you read it? Have you read the answer? Okay. Now, the second requirement, discuss the ethical issue arising from the scenario, including any action which Farham and accountant should undertake. Yes, ethical issues. Okay. What do you think that being an accountant, what is our ethical duty? What do you say? Being an accountant, what is our ethical duty being an accountant? Any input from your side? Being an accountant, our duty is that the financial statements should present true and fair view. Am I right? True and fair view. There should be a compliance with all professional standards, including the accounting standards. They should be unbiased. There should be unbiased information. The accountant should be neutral, should act a neutral person. There should be no self interest. Being an accountant, these are our ethical duties. Okay. Now, if we focus on the accountant, it seems that accountant does not have the sufficient knowledge of the accounting standard, because here the accountant of a firm want to create a provision of future trading losses and expected disposal cost. It's indicate that he does not have sufficient competence or sufficient knowledge of the accounting standard. This is an issue in the accountant. Okay. And another issue which we have for the accountant is that the accountant is being intimidated. The accountant has been intimidated by the chief operating officer that the accountant may lose his job. And this intimidation may create the self-interest for the accountant. And he may wish to act, he may be forced to act as per the wishes of the chief operating officer, who does not want to include any provision in a financial statement. Because he's saying, as per the chief operating officer, if they made the provision, the financial statement will be deteriorate, their bonus target will not be met, and we will not secure a good price for the sale of the new wall. So the chief operating officer is trying to manipulate the things, and that is not a right thing. Okay, and you get it. So for the accountant, it is necessary that he should update himself from the relevant accounting standard, and he should not be intimidated by the chief operating officer. So if you look at here the answer, the accountant have a duty to ensure that the financial statement are fair, transparent, and comply with the accounting standard. Accountant appear to have made a couple of mistakes which would be unexpected from professionally qualified accountant. In particular, the accountant appears unaware of which cost should be included within the restructuring provision and has failed to recognize that there is no obligating event in relation to future operating losses. Accountant must carry out their work with the due care and attention for the financial statement to have credibility. They must therefore ensure that their knowledge is kept up to date and they do carry out their work in accordance with the relevant ethical and professional standards. Failure to do so would be a breach of professional competence. The accountant must make sure that they address this issue through for example, attending regular training and professional development courses. There are a number of instances that which suggest that there is a chief operating officer is happy to manipulate the financial statement for their own benefit. She is not willing to account for an impairment loss for the subsidence despite knowing that it is a contrary to the international accounting standard. She is unwilling to create a restructuring provision. All the adjustment required to ensure the financial statement comply with the international accounting standard will reduce the profitability. It is true that a director do have a responsibility to run the group on the behalf of the shareholder and to try to maximize their return. This must not be to the determinant through producing the financial statement which are objective and fruit faithfully represent the performance of the group. It is likely the chief operating officer is motivated by the bonus target and is therefore unfairly trying to misrepresent the result of the group. The chief operating officer must make sure that she is not unduly influenced by this self-interest threat. Chief operating officer is also acting unethically by threatening to dismiss the accountant should they try to correct the financial statement. It is not clear whether the chief operating officer is qualified accountant, but the ethical principle should extend to all employees, not to just a qualified accountant. Threatening and intimidating behavior is unacceptable against all ethical principles. The accountant faces an ethical dilemma. They have a duty to produce the financial statement which objective and fair, but do so could mean that they lose their job. The accountant should approach chief operating officer, remind them of the basic ethical principle and try to persuade them of the need to put the adjustment through the consolidated account so that they are fair and objective. Should the chief operating officer remain unmoved, the accountant may wish to contact the ECC ethical helpline and take legal advice before undertaking any further action. So that is the ethical part. And I told you in the last lecture that in a question number 2, there will be an accounting issue like here. We have the accounting issue and ethical implication. So question number 2, this was the question number 2 and it is from December 2018 attempt. Yes, this is from September 2018 attempt. And when you will get the question bank, this is a question number 2, which we have just attempted. Now, you people have the notes or not? Have you people get the question bank or not? Students, have you get the question bank? Okay. Okay, then contact with the management and ask them to share the question bank as well. Okay, and when you get the question bank, kindly note the question. In a question bank question, in a question number 5, in a question bank question number 5, December 18, part C. Will be the homework. Now the next accounting standard
we're going to discuss is borrowing cost, IAS 23. What does mean the borrowing cost? Borrowing cost mean interest expense, finance cost is another name of the borrowing cost. Discount on the issue of loan notes, premium on redemption of loan notes. These are all the examples of borrowing cost. Usually the borrowing cost, we know expense out in profit and loss account. But if entity is using borrowings to construct or acquire and qualifying asset, then borrowing cost must be capitalized. Okay. So if I am using the borrowings, loans to construct or acquire a qualifying asset, then the borrowing cost will be capitalized as the part of the cost of the asset. Now, what is qualifying asset? Qualifying asset means which take substantial time period to become available for use. That asset is known as qualifying asset. Example are bridges, dams, buildings, or specialized inventories, or anything which is going to take substantial time period. That will be known as qualifying asset. And if we are using the borrowings to construct or acquire the qualifying asset, then interest cost will be capitalized as the part of the cost of the asset. It will be capitalized. And it will be capitalized if interest cost is being
incurred, interest cost is being incurred, expenditure on asset is started, and a necessary activities to construct the asset are completed. When all these conditions are fulfilled, from that date, interest cost will be capitalized as a part of the cost of the asset. And these conditions are known as, if you remember, commencement of capitalization. Commencement of capitalization. Now, for example, on 1st January X1, we have a loan. On 15th January X1, we get the approval. And then on 1st April X1, we start the construction. So that means the interest cost in this period will be capitalized except for suspension. Interest cost will be capitalized except for suspension. And the interest cost during this period in a green area, this interest cost will be expensed out in profit and loss account. You get the concept? Please read the following. Read the highlighted area. So have you read it? So the borrowing cost for a acquisition or construction of a qualifying asset must be capitalized. Have you read it? No, read this example as well. A company constructing a warehouse take out a loan to finance the construction and interest cost of 12,000 each month. Company should capitalize those interest costs incurred from the time that work on construction begins until the time the warehouse ready for use. The cost of constructing an asset may be financed out of general company borrowings rather than specific loan. In this situation, it may be difficult to identify the borrowing linked to one particular asset. IS 23 required that in this situation, the borrowing cost attributable to asset should be calculated by the reference of weighted average cost of interest, across the range of the borrowing. So if you remember, we have two scenarios. One is specific loan and one is general borrowings. Um, in general borrowing, it is very simple to calculate the interest cost to be capitalized. We just take the interest of the outstanding loan and we will capitalize the interest cost during the commencement period. But if we have a general borrowing means we are using the we have not taken the specific loan. We are using the bank overdraft or the other running finance facility. In that case, we use the average cost to determine that how much cost should be capitalized as the part of the cost of the asset. At SBR level, he is not going to ask us to calculate which we are used to calculate at FR level. At SBR level, we just need a concept that if we are constructing or acquiring a qualifying asset, and for that purpose we have the borrowings which we are utilizing to construction or the acquisition of the qualifying asset, then that interest cost must be capitalized as the part of the cost of asset. Okay. You get it? Okay. Okay, students, now we have the other lectures. We have completed the 37, IIFRS 5 and IS 23, and we also done the IS 10 in this sitting. Now we will continue the class with the revision of IS 16 property, plant and equipment. In IS 16, we cover tangible non-current assets, which are typically known as property, plant and equipment. And property, plant and equipment are those non-current assets that are to be used on continuing basis. Those assets which are to be used on continuing basis in a business, those non-current assets, those tangible non-current assets are known as property, plant and equipment. And through that use, continuous use, the entity get the economic benefit. And they are covered in IAS 16. And they are covered in IAS 16 property, plant and equipment. A property, plant and equipment must be a tangible asset. It should not be intangible asset. If that is intangible, then for that purpose we have intangible non-current asset IAS 38. And the example of the property, plant and equipment are land and building, plant and machinery, motor vehicle, furniture, fixture, fittings. These are all the examples of the tangible non-current assets held by business for use in a business. And the use for which the purpose for which they are used, that might be used for administrative purpose, for the manufacturing processes, for administrative purposes, or to rent out those tangible assets to other parties. Such purposes are relevant for IAS 16. Initially, when we acquire a property, plant and equipment, we know that initially it is measured at cost. Initially, it is measured at cost, and cost is usually is equal to list price minus trade discount, plus import duties, non-refundable taxes, plus any directly attributable cost to bring the asset into intended use. That include the professional charges, that include the freight charges, legal cost, site preparation cost, installation cost, asset testing cost, are the example of directly attributable cost. Dismantling cost is also capitalized as the part of the cost of the asset. Dismantling cost we discussed in IAS 37 as well. Dismantling and site restoration cost, initially it is made at present value and capitalized as the part of the cost of the asset. For example, we will not going to take too much time here because it is a basic knowledge of FR and or your basic study. We just need to revise this. For example, entity H has incurred the following cost prior to bringing the machine into full production. Purchase price before rebate and taxes 1220. Trade rebates are 600. Refundable taxes are 1200, architect fees 700, installation cost 100, operating losses prior to achieving the required performance is 250. Now, what do you say? Rebates and refundable purchase taxes, these should be capitalized or not? This should not be capitalized. So purchase price less rebates 11,600, architect fee and installation cost will be capitalized. So we have initial cost of 12,400. In initial measurement, we discussed if we have the borrowings, then the interest cost on the borrowings can be capitalized as the part of the cost of the asset. Initial measurement is also affected by the government grant. Sometime government assist the entities in purchasing the non-current asset. Now, if we have a government grant, government has given us grant to purchase or assist us in a purchasing of a non-current asset, then we have two treatments. If you remember in IS20, we have two treatments to account for the government grant. One treatment was that we record the government grant as in deferred income, and as we use the asset, we release the government grant in a profit and loss account. For example, we have a plant of 10,000, and on that plant we have a government grant of 4,000. So it will be recorded as an asset and it will be recorded as a deferred income in a statement of financial position. And if, let's assume, the useful life, the plant is 4 years. So at the end of the year 1, depreciation will be 2,500 and deferred income will be amortized by 1,000. So at the year end, in a profit and loss account, we will record a depreciation expense of 2,500 and we will record a deferred income of 1,000 as an income in a profit and loss account, and net effect will be 1,500. And in a statement of financial position, the property, plant and equipment will be 7,500. On the asset side, and on the liability side, we have a deferred income of 3,000. So the net effect will be 4,500. And the second approach, which we can use to account for the government grant on a property, plant and equipment, is that the cost of the plant is 10,000, but out of 10,000, government has given us 4,000. So our net cost is 6,000. So we record the asset at 6,000. We net the government grant in the cost of the asset. So at the year end, when I will depreciate 6,000 divided by 4, depreciation will be 1,500. And in a profit and loss account, I will report the depreciation of 1,500. And in a statement of financial position, I will report the property, plant and equipment at 4,500. These are the two approaches. The net result is the same. The net result is the same, but we have the two approaches to deal the government grant in case of property, plant and equipment. Okay. Either we record as a deferred income or we reduce the deferred income from the cost of the asset. So the government grant will affect the initial measurement of the property, plant and equipment. Please read this example. The company received a grant of 300,000 towards the acquisition of a machine costing $500,000. The machine has a useful life of 5 years. Once again, a grant should be matched against the associated cost. There are two acceptable accounting approaches in this situation. Option 1, we deduct the grant from the cost of the asset and record the asset at the net value of $200,000. And option 2, we record the asset at a full value, $500,000, and record the $200,000 as a deferred income liability, Now, if we deduct the government grant from the cost of the asset, the net cost is 200,000, and 200,000, if depreciated over 5 years, annual depreciation will be $40,000. But in option 2, if we record the asset at $500,000 and we depreciate it over the 4 year, over the 5 year, depreciation per year will be $100,000, and a deferred income will be amortized over the 5 years, and per year deferred income will be 60,000 which will be transferred as an income to profit and loss account. So the net effect again will be $40,000. Okay, you get the approach, you get this approach, that how the government grant may affect the initial measurement of the property, plant and equipment. Okay, students. Cost of a non-current asset subsequent expenditure. Dear students, remember only one principle that if due to any expenditure, we the economic benefit of the property, plant and equipment increase. If due to any expenditure, economic benefit of the property, plant and equipment increases. For example, there is an increase in useful life of the asset. Maybe there is an increase in efficiency or effectiveness of the asset. Then such subsequent expenditure will be capitalized as the part of the cost of the asset. Okay, any expenditure which increase the economic benefit, future economic benefit of the asset, that will be capitalized. On the contrary, if that is not the case, then such expenditure will be expensed out immediately in profit and loss account, in a profit and loss account. Okay. Okay, students. Now I'm leaving the class here, and you people you people get the notes as you told me. Or if you haven't get these notes, kindly contact with the management and get it as soon as possible. So please read the notes till this point before 1.6. It is the revision of I-16, not a difficult task. And this is the chapter number 4 from your notes, chapter number 4. And IIFRS 5 is completed. This is also part of the chapter number 4. And I-37 and I-10 is in chapter number 10. Okay. So this is your task. Before the next class, you people should revise these things. Okay. Now from the next class, I will continue the I-16, and then we'll complete the I-40 and I-38, including the I-36 in the next class. We will be revising the I-16, I-40, I-38 and I-36 in the next class. Okay. Okay, students. Goodbye and take care. See you next week or in the next class.